When we step into the marketplace, we step into a world shaped by human intentions, fears, ambitions, and habits. And if you've studied my work for any amount of time, you know that the market speaks most clearly through the relationship between price and volume. Before we begin, let me say, today's lesson naturally follows the rhythm we started in the previous video on volume patterns every investor must know. So if you've been following along, this will feel like another layer being added to your growing tape, reading instincts. Now, let's talk about this idea of a volume climax versus volume exhaustion. Two conditions that can look similar to the untrained eye, yet speak entirely different messages. And let me ask you right from the start, have you ever stared at a massive volume spike and felt unsure whether it signaled opportunity or danger? If so, you're not alone. This confusion has sent many traders chasing shadows on their charts. A volume climax is the market shouting. It's a burst of energy, a declaration that strong hands are stepping in while weaker hands, often in a state of emotional distress, are stepping out. It is the kind of moment where effort hits its highest peak, and the crowd believes a trend will continue forever. But you and I, as students of the real forces beneath the surface, must ask who benefits from that belief, who is taking the opposite side. Because as I've been teaching for years, the composite operator doesn't donate liquidity, he absorbs it. And at climactic moments, he absorbs more than ever. But exhaustion is different. Exhaustion is a whisper. It is the quiet tapering of energy when the market simply runs out of commitment. Picture a trend that has carried on longer than it deserved, floating upward like a balloon losing air. Volume fades, not because someone has stepped in aggressively, but because everyone is simply tired. And if you think about your own experiences as a trader, haven't you sensed that moment when the crowd just lets go? One is loud and emotional, the other is soft and depleted, yet both reveal where the opportunity lies, if you know how to read them. As you listen, I want you to imagine the chart not as lines and bars, but as human behavior made visible. When volume reaches a climax, it is the crowd panicking or chasing, and the professional calmly harvesting liquidity. By contrast, when volume exhausts, it signals that even the crowd itself has lost interest. If you were the composite operator, wouldn't those low-energy zones be the perfect moments to test supply or demand with a light touch? Now, remember how in the earlier video, our session on volume patterns, every investor must know, we talked about the rhythm of effort versus result. Here's where the principle becomes practical. A climax shows enormous effort, and the result afterward tells you if that effort was genuine demand or simply the last gasp of emotional traders. Exhaustion, on the other hand, shows very little effort at all, and that lack of energy is in itself a result. The market tells you everything if you're willing to observe without bias. When you see a climax, ask yourself, is this the culmination of a trend? Is this where the weak hands finally give up or get carried away? For example, in a selling climax, the volume explodes as fear reaches its highest pitch. Many sell because they cannot bear the pain any longer. Professionals, meanwhile, welcome the supply with open arms. They've been waiting for it. And let me ask you this. Haven't you ever sold at the exact moment when the pain felt unbearable, only to see price reverse shortly afterward? That is no accident. That was your emotion signaling a potential turning point. At the opposite end, buying climaxes appear as the crowd grows intoxicated with optimism. News is good, price has been rising, and suddenly every beginner wants just one more share. These are often the final waves of emotional buying. When the public becomes too enthusiastic, the rally becomes fragile, because it relies on unsustainable sentiment. You'd be surprised how often a buying climax marks not strength, but vulnerability. Now, compared to the climax, exhaustion feels subtle. It's the final drift upward or downward, when nobody seems to care anymore. This is why exhaustion often precedes springs or upthrusts, the tests that professionals use to check whether any meaningful supply or demand remains. And if you're wondering why such moments matter for your trading mindset, think about this: as a trader, your wealth grows not simply from taking trades, but from learning when not to be lured into low probability situations. Patience is as much a part of capital growth as analysis. And by the way, thinking back to the ideas from that previous video on volume patterns, every investor must know. Notice how exhaustion lines up with those low effort bars we discussed. The absence of participation is itself a clue, often signaling that a move is ready for a test or reversal. Understanding this connection strengthens your reading of every chart you study. Once you internalize these distinctions, you begin to anticipate where profitable zones often form. You start seeing the footprints of accumulation and distribution more clearly. And with that clarity comes a calmer mindset, one grounded in observation rather than impulse. Let me ask you how much stress in your trading has come from acting too quickly, instead of waiting to see whether the market was showing climax or exhaustion. One simple shift in perspective can stop you from stepping in front of a freight train or, just as costly, from missing the moment the train is about to reverse. Now consider how smart money behaves at these turning points. During a climax, they act decisively, absorbing panic-driven orders while maintaining emotional neutrality. That neutrality is part of their edge. They do not celebrate the buy, nor do they fear the sell. They simply follow the principles. And if you've been working on your money mindset, you know that emotional neutrality is not a luxury. It's a requirement for survival. Exhaustion, too, reveals the professional's temperament. They wait for the public to lose interest. They wait for volume to thin out so their tests can be performed without resistance. They wait because waiting is a form of strength. And isn't that the same kind of strength you strive for in your own account management, staying disciplined even when the screen rewards impatience? When you learn to distinguish climax from exhaustion, you give yourself a roadmap to potential profit zones. Not guaranteed riches, not magic signals, just a clearer grasp of where supply and demand are shifting. And in a market built on psychology, that clarity is worth more than any shortcut or secret pattern. A volume climax signals emotional crowd behavior met by professional absorption, and to truly understand why this single idea holds so much power in chart reading, we have to look beneath the price bars and into the psychology that produces them. A climax is not just a big volume spike. It is the moment when market emotion reaches its highest pitch, when the public, after resisting for as long as they can, finally capitulates. They either give in to fear during a sharp decline or surrender to greed during a euphoric rally. And have you ever noticed how your own emotions tend to peak right before major turning points? That's because the climax is the battlefield where the weak hands make their last stand and the strong hands quietly take control. During a selling climax, for example, you'll see traders dumping shares because they can't bear the pain anymore. Each down bar feels heavier than the last. Every tick lower triggers more panic. It's as if the market amplifies every emotion until people stop caring about analysis altogether and simply want out. But while this emotional storm is swirling, the professional operator, calm, analytical, and prepared, is waiting to absorb all that frantic supply. He's been watching and planning, sometimes for days or weeks, and he recognizes that such extreme emotion is often temporary. So while fear drives the public to sell, he steps in with a different motive: accumulation. Not because he hopes or guesses, but because he sees what the emotional trader cannot see: opportunity hidden inside chaos. On the other hand, during a buying climax, enthusiasm becomes the dominant force. Prices rise sharply, news is positive, social sentiment turns into celebration, and traders who stayed on the sidelines finally decide they must get in. Every uptick feels like confirmation. Every slight pullback feels like a chance to add. But beneath that rising excitement, the professional begins to distribute. He sells into that emotional demand because he knows the crowd is acting late. The movement has already traveled far, and those emotional buys often represent the final surge before the market runs out of buyers. And let me ask you directly, how many times have you felt the urge to buy only after a chart looked safe, because it had already risen for a long time? That impulse itself is a clue that the market may be entering climactic territory. A true volume climax shows up when massive effort is made, yet the result begins to diverge from expectations. In a selling climax, price pushes down aggressively, but you might notice that each new low doesn't travel much farther than the previous one, or the spread of the bars begins to narrow. In a buying climax, price pushes up, but the bars lose their range or close off their highs. This effort versus result imbalance is crucial because it reveals that while emotion is producing tremendous volume, the underlying force behind the move is weakening. The crowd is exerting effort, but the professionals are absorbing it, counteracting it, or using it to shift the trend. When a volume climax appears, the trading range that follows is often the professionals' playground. They stabilize price, shake out remaining emotional traders, and prepare for the move in the opposite direction. But notice something important: a climax doesn't guarantee reversal. It signals a potential turning point and invites deeper study of the price action that follows. A climax without supporting structure might simply mark a pause. Yet a climax followed by shortening thrusts, tests of supply or demand, and controlled professional behavior speaks volumes about intent. This is why traders who rely only on the volume spike often misread the situation. The volume itself is not the signal. The interaction between that volume and the resulting price behavior is what reveals the true story. The reason professionals thrive during climactic moments is because they remain emotionally neutral. They don't rush. They don't panic. They don't chase. They watch the crowd behave predictably and use that behavior to their advantage. Meanwhile, inexperienced traders often misunderstand what's happening. They see a huge volume bar and assume it reflects strength in the direction of the move. But in reality, the biggest bars frequently appear because emotion has hit its highest possible level, and when emotion maxes out, exhaustion follows, not always immediately, but inevitably. After all, the crowd cannot sustain a frenzy forever. One of the most powerful things you can do as a trader is to learn to interpret climactic volume, not from your own emotional perspective, but from the perspective of the composite operator. Imagine you are the one accumulating during a panic or distributing during a frenzy. Wouldn't a spike in volume give you the liquidity you need? Wouldn't it make sense to wait for those rare moments when the public is acting with complete emotional conviction? Because conviction without analysis leads to predictable decisions. When you approach the chart from that vantage point, a volume climax becomes more than a visual cue. It becomes a signature of human behavior at its extremes. A moment when the final burst of emotion tells you that the trend may be near its natural end, and that the professional is stepping in to guide the next phase of the movement. And understanding this dynamic is not about predicting the market with certainty. It's about learning to read the underlying forces so you can navigate with clearer judgment and stronger discipline. Volume exhaustion reveals dwindling participation and weakening trend commitment, and to grasp the true meaning of that, you must learn to see the market not as a machine, but as a living crowd whose interest rises and falls with every passing wave. Exhaustion is subtle. It doesn't shout the way a climax does. It doesn't carve dramatic spikes or dramatic reversals. Instead, it shows up quietly, the way a long conversation drifts into silence when the energy behind it fades. And if you've ever watched a chart that seemed to float upward or drift downward without conviction, you've seen exhaustion in action, even if you didn't recognize it at the time. Where a volume climax is loud and emotional, exhaustion is almost the opposite, a gradual thinning out of participation. Picture a trend that has been running for a long stretch. The public was engaged early. Enthusiasm kept the movement alive. But over time, the move stops inspiring new traders. Buyers get tired. Sellers get tired. The market keeps moving, but only because no one is actively opposing it. Have you ever noticed how a trend can continue simply because no one cares enough to fight it? That's the essence of exhaustion. Movement without meaning. As price pushes forward in this low-energy environment, the bars begin to tell a story of diminishing interest. The spreads shrink, the volume tapers off, and the character of price movement becomes soft and irregular. If you're watching closely, you'll see that the effort behind the move is fading. This is where most inexperienced traders get fooled. They assume that a continuing trend is strong simply because it hasn't reversed yet. But in reality, the absence of activity is often more important than activity itself. Would you be comfortable joining a move where no one else seems to be participating? Would you trust a rally that drifts upward on declining volume, or a decline that trickles downward with barely any pressure behind it? Professionals understand that these low-energy conditions open the door for testing. When volume is thin, a small probie, a temporary push to see who's still willing to buy or sell, can reveal the entire internal structure of the move. If the professional nudges price downward during an uptrend and barely finds any supply, it tells him that the path is clear to continue the markup. If he nudges upward during a downtrend and finds no genuine demand, he knows distribution or markdown may continue with little resistance. Exhaustion creates clarity, not through intensity, but through stillness. What makes exhaustion such a valuable signal for traders is that it exposes the market's loss of commitment. Think of a long rally that has been climbing for weeks. Early buyers were enthusiastic, later buyers were optimistic, but toward the end, participation falls off because the crowd feels uncertain. Those who wanted to buy have already bought. Those who were skeptical stay skeptical. The result is a thinning, out effect. Price rises, but not because of strength, simply because sellers aren't stepping in. It's like a car rolling on momentum rather than engine power. Without fresh energy, it will eventually slow, stall, or become vulnerable to even the smallest resistance. The same happens in a prolonged decline. Early sellers are passionate. Fear fuels the movement. But eventually the emotional energy drains away. Traders get exhausted, both psychologically and financially. Volume dries up, not because the market is strong, but because there are fewer participants left who believe the trend will continue. That lack of commitment is the very soil in which springs, shakeouts, and reversals are planted. And if you think back to your own trading decisions, haven't you hesitated during slow, drifting markets because they felt unclear? That feeling is the same exhaustion the chart is quietly recording. One of the most important aspects of understanding exhaustion is recognizing that it doesn't guarantee reversal. Instead, it reveals vulnerability. A trend built on dwindling volume becomes fragile. It can continue for a while, but it becomes increasingly sensitive to shifts in supply or demand. A small burst of selling after an exhausted uptrend can cause a larger than expected reaction. A small burst of buying after an exhausted downtrend can spark a sharp rally. It's not the push that matters. It's the environment into which the push occurs. This is why professionals often wait for exhaustion before making their key moves. In a high-volume environment, testing requires significant effort. In a low-volume environment, the same test yields clearer results with less risk. Lower participation means fewer surprises, fewer unpredictable traders stepping in, fewer emotional decisions interfering with structure. The professional waits, observes the dwindling activity, and then probes the market to gauge its internal readiness. And if you were operating with large capital, wouldn't you also prefer to test the market when no one else is paying attention? On a psychological level, exhaustion reflects something important about trader mindset. When traders stop believing strongly in a move, their actions become half-hearted. Some hold on simply because they don't want to exit too early. Others avoid joining because the movement lacks conviction. This creates a market that drifts more than it drives. A drifting market is a vulnerable market. That vulnerability allows professional traders to create the conditions they need for accumulation, distribution, or reaccumulation. When you learn to detect exhaustion, you start to understand the difference between a healthy trend and a hollow trend. A healthy trend is fueled by participation. Buyers stepping in repeatedly on increases, sellers contributing consistently in declines. An exhausted trend runs mostly on autopilot. You'll often see price rising or falling with reduced spread, weaker closes, and irregular rhythm. These are the footprints of a move losing steam. And once you can identify that loss of energy, you gain the ability to anticipate the moments when new structure is likely to form, when tests will appear, and when professionals may shift their behavior. Understanding exhaustion gives you patience. It teaches you not to chase a move just because it's still going in one direction. It teaches you to question whether the market's movement reflects real conviction or or simply a lack of opposition. And most importantly, it helps you recognize when opportunity is forming beneath the surface, quietly, without the noise and chaos that often distract less experienced traders. Climax bars often mark the final surge of fear or euphoria before reversal, and to fully understand what that means, you have to step inside the emotional core of the market. A climax is not just a tall bar on your chart. It is the eruption of collective psychology after a long build-up. It is the moment when traders who resisted, doubted, or hesitated finally give in, whether to panic or excitement, and their sudden rush to act creates the surge you see on the screen. If you've ever felt that moment where you could no longer hold your position and you had to sell or buy, you've personally experienced the emotional energy that forms a climax bar. In a selling climax, fear reaches its boiling point. The market has been falling for some time, and traders holding losing positions begin to feel trapped. Each drop feels heavier than the last, every bounce gets sold into, and the emotional pressure builds. Eventually, that pressure becomes unbearable. Traders exit not because they analyze that it's the right time, but because they cannot stand the pain any longer. This is how massive volume gets generated. When large numbers of participants hit the sell button simultaneously, volume explodes. And in the middle of that storm, have you ever noticed how your own judgment becomes clouded? How logic fades and emotion takes over? That state of mind is exactly what fuels a selling climax. In a buying climax, the emotional engine is different but equally powerful. Instead of fear, it's euphoria. Price has been rising, news turns positive, and the public begins telling itself that the trend will never stop. People who missed the move earlier start to feel left behind. Traders who already bought feel emboldened and start adding. Social sentiment warms, opinions strengthen, and certainty grows. But as this wave of enthusiasm rolls in, professional traders quietly begin to sell into it. They sense that the demand is emotional, not sustainable, and the massive volume on the buying climax often reflects the final push of those late buyers, people who waited too long and now feel they must participate at exactly the wrong time. The key insight is that climaxes are emotional extremes. They appear because the crowd reaches the point where it cannot behave rationally any longer. Emotion takes full control, and once emotion peaks, it has nowhere left to go. Think about your own moments of trading panic or excitement. Wasn't there always a sense of, I can't take this anymore, or I don't want to miss this? That inner dialogue is the same emotional force that shapes climaxes across every time frame and every market. But what makes a climax bar so important for traders is not just the emotion behind it, it's the effect it has on structure. A climax often clears out weak hands. In a selling climax, traders holding long positions capitulate, flooding the market with supply. Professionals absorb that supply because they see the emotional surrender as the final flush of selling pressure. When that selling dries up, the market becomes lighter, easier to lift. In a buying climax, the opposite happens. The late surge of buyers creates a flood of demand, and professionals use that demand to unload their positions. Once the enthusiastic buyers have committed themselves, the market becomes harder to push upward, easier to push down. This shift in control, from emotional traders to professional operators, is one of the clearest signs that a trend is approaching its end. A climax bar acts like a signal flare. It tells you that emotional energy has reached its peak, and peaks don't sustain themselves. Yet many inexperienced traders misunderstand this and assume that massive volume during a strong move must indicate continuing strength in that direction. They see a huge green bar and think bullish, or a huge red bar and think bearish. But the truth is more nuanced. The biggest volume often marks the point where the dominant emotional force is burning out. Climax bars also reveal the struggle between effort and result. Consider a selling climax. Price pushes down violently, but the widest bar might come just before a reversal. Why? Because although the crowd is exerting massive effort through panic selling, the results begin to diminish as professionals absorb the supply. Price stops falling as quickly. The lower shadows or slowing thrusts tell you that the heavy selling is being met by strong hands. Similarly, in a buying climax, price races up, But then you notice the closes weaken or the bars narrow at the top. Even with enormous effort from euphoric buyers, the result becomes less convincing because professionals are absorbing that demand. Another important characteristic of climax bars is their ability to reveal opportunity through contrast. Before the climax, volume often builds gradually. During the climax, it explodes. After the climax, it collapses. That shift in rhythm, high intensity abruptly followed by quietness, is a powerful tell. It shows that the emotional wave has passed. Professionals often step back and allow the market to settle, watching how price behaves without the emotional crowd. This settling process creates the early stages of a new range, a base or distribution area, where the next phase of the market is shaped. Climax bars also test your psychological resilience as a trader. They challenge your ability to stay calm when others are panicking or chasing. When everyone is reacting emotionally, the temptation to join them can be overwhelming. But understanding climaxes gives you a different perspective. It teaches you to pause when others rush, to analyze when others react, and to ask yourself the kind of questions most traders never ask. Instead of thinking, price is collapsing, should I exit immediately? You begin to think, is this the kind of emotional surge that often marks a selling climax? Instead of, this rally is unstoppable, should I jump in? Use enthusiasm nearing exhaustion. Recognizing climax bars helps you time your analysis around the moments. These are the moments when the entire structure becomes easier to read because emotion strips away complexity. The panic seller and the euphoric buyer behave in predictable ways, and their urgency becomes visible on the chart. Professionals take advantage of those predictable emotions, not through manipulation, but through patience and understanding. They wait for the crowd to reveal its hand, and the climax bar is often the clearest reveal they get. Understanding climax bars is not about predicting reversal with absolute certainty, but about recognizing the moment when a trend's emotional engine is reaching its final push, when the market is vulnerable, and when the structure is ready to shift into a new phase. Exhaustion zones frequently precede tests like springs or upthrusts, and the reason behind this lies in the nature of how markets behave when participation dries up. When traders talk about exhaustion, they often think of a tired trend or a quiet stretch of candles. But exhaustion is more than just silence on the chart. It's a signal that the market is becoming structurally lighter, easier to move, and more susceptible to the tests that professional operators rely on to confirm whether supply or demand still remains beneath the surface. Have you ever watched a market drift so gently in one direction that it felt like no one was really behind the move? That drifting sensation is one of the clearest hints that exhaustion is setting in. As participation decreases, the market loses its depth. Think of it like a pool where the water level is gradually receding. When the water is deep, you can't touch the bottom easily. You can splash and move, but it takes effort to make waves. But when the water becomes shallow, even a small kick creates a disturbance. That's how low volume affects the market. Small orders begin to have outsized effects, and the professionals who want to test supply or demand can do so with minimal risk. This is why exhaustion zones often appear just before springs in accumulation phases and upthrusts in distribution phases. The fading energy provides the ideal environment for a clean, controlled test. Consider a long downtrend that has slowly lost its selling pressure. In the early phases, each drop brings strong emotion, heavy volume, and commitment from the crowd. But as time goes on, the selling energy weakens. Fewer traders are willing to sell at lower prices. Each leg downward shows declining volume, narrowing spreads, and lack of enthusiasm. Eventually, the market reaches an exhaustion zone, where even a small push downward finds almost no resistance. At this point, the professional operator can step in and test the market with a spring. A spring pushes price slightly below the established support or trading range. But because selling has dried up, the moment price dips below support, almost no meaningful supply shows up. Professionals can then lift price back above the level, demonstrating that the downtrend has lost its force and that accumulation is likely underway. The beauty of this behavior is in its simplicity. The professional isn't manipulating anything, he's confirming. He wants to know whether supply is truly gone or merely hiding. If supply appears during the test, price will struggle or fail to recover, signaling that the exhaustion was incomplete. But if supply remains absent, the spring becomes the starting point for a new move upward. This is why traders who understand exhaustion zones can identify some of the cleanest reversal setups. They aren't chasing strength. They're reading the absence of strength in the prior move. The opposite happens in distribution phases, where an uptrend enters a zone of weakening demand. After a long rally, early buyers are satisfied, momentum traders lose confidence, and new buyers become scarce. The market may still inch upward, but the energy behind each candle is thin. Volume drifts lower, and the character of price becomes soft and hesitant. This is the environment in which professionals stage an upthrust. An upthrust pushes price slightly above resistance or the prior high, just enough to tempt remaining breakout traders into buying. But because demand has already faded, the breakout cannot sustain itself. Price quickly falls back into the range, revealing that the uptrend was exhausted and distribution is at hand. Have you ever chased a breakout only to watch it reverse immediately and trap you? That's the effect of an upthrust forming in an exhaustion zone. The breakout feels real, because price is moving upward, but what you don't see is that the move has little fuel. The professionals use that lack of demand to test the market's internal strength, and when they find none, they shift their behavior from selling lightly to selling aggressively. From your perspective as a trader, understanding this dynamic saves you from one of the most common traps in market behavior. Exhaustion zones matter because they strip away noise. In a highly active environment, it's difficult to tell whether a breakout or breakdown is genuine or merely another fluctuation in a volatile trend. But in low-volume environments, price movements reveal themselves more clearly. When a spring fails, you know supply is still present. When an upthrust fails, you know demand is still lurking. But when these tests succeed, when price returns to the range quickly and decisively, you can interpret it as confirmation that the prior trend has reached its limits. There's a psychological dimension to exhaustion as well. Trends end not simply because the chart says so, but because trader interest fades. People stop engaging with the move. They stop placing orders. They stop caring enough to push price further. This collective loss of interest becomes a structural weakness in the trend. Professionals read this weakness the same way a builder reads the strain in a wall before deciding whether it will hold or fail. They look for the cracks in participation, the thinning in commitment, and the diminishing reaction to price movements. Once they identify exhaustion, they use springs or upthrusts as diagnostic tools. These tests give them information. They reveal whether the market is ready for reversal or whether the prior trend still has enough energy to resist. And as a trader, once you understand how these tests operate and why they often follow exhaustion zones, you begin to anticipate structure instead of reacting to surface-level movements. You stop seeing tests as traps and start seeing them as opportunities. In the end, exhaustion zones are the quiet moments before the most important decisions in the market. They are the pauses before springs launch accumulation into markup, and the hesitations before upthrusts launch distribution into markdown. They are not dramatic, but they are defining. They allow the professional to gather information with minimal effort, and they give the attentive trader a window into how supply and demand are shifting beneath the surface.